I know.
Alrighty, I'm going to give you guys all keyboard and mouse control. Just remember, when you're not talking, don't touch your mouse.
Do you have the, did you hit record?
I did hit record.
Okay.
And we're going to start right now. You ready?
We're ready.
Yep. Here we go.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning. I'm Poppy Behrens, publisher of Minico Incorporated, and I'd like to welcome you to today's webinar. For those of you who are joining us for the first time, this is one of our monthly webinars presented to self-storage owners, operators, managers, investors, developers, and other industry professionals. Today's presentation is CMBS loan workouts, modifications, and maturity extensions. The sponsors of today's webinar are the BSC Group and First Service Solutions. The BSC Group offers financial and loan advisory, mortgage brokerage, and workout solutions to commercial real estate property owners and investors with a special emphasis on the self-storage market. First Service Solutions was the country's first firm dedicated to serving as a borrower advocate in loan restructuring and assumptions for CMBS borrowers. Combined, the two firms have secured more than $1 billion in financing for self-storage clients and have resolved more than $2 billion in loan restructuring and $1.7 billion in assumptions for clients with all property types nationwide. The webinar today will be presented by Sean Hill, Principal with the BSC Group, Devin Huber, Principal with the BSC Group, Brock Andrus, Senior Director at First Service Solutions, and Todd Moore, Executive Vice President of First Service Solutions. Self-storage industry with in-depth news and information about timely topics and the latest industry trends. Minico also publishes a variety of other self-storage data sources such as those used on your screen. For more information, please visit ministoragemessenger.com. Before we get started, I'd like to cover a few webinar basics. Today's webinar is being recorded. It will be available for viewing on demand from our archives at ministoragemessenger.com, where you can also find information about our other upcoming webinars. This presentation should run about 45 minutes, with the remainder of the hour open to questions and answers. As such, we invite you to submit your questions throughout today's webinar by typing the question into the question area and clicking send. While we will try to answer as many submissions as we can at the end of the webinar, those that cannot be answered due to time constraints will be answered by way of email after the webinar has concluded. And now it's my distinct pleasure to turn the presentation over first to Sean. Good morning, Sean.
Thanks, Poppy. I'd like to thank everybody for joining us today, and I guess I'd be remiss if I didn't give a quick shout out to the Blackhawks looking to bring home the Stanley Cup tonight. And for those of you around the country that missed the cover of yesterday's Chicago Tribune, it surely was a classic. Today, joining me from the BSC Group, I have Devin Huber, my business partner, and we have our alliance partners from First Service Solutions, Todd Moore and Brock Andrus on the phone. And we're going to be talking with you about a pretty timely topic, CMBS loan workouts, modifications, and maturity extensions. Given the distress in the market, it certainly is something that we've been hearing a lot about and are going to be hearing more about in the future. But what I'd like to do is just quickly talk about what we're going to be discussing. First, we're going to cover who's on the phone today, who we are and why we're qualified to talk with you about this topic. Second, given that the focus of this presentation is really not on bank debt, it's on securitized debt, we're going to help you to identify whether or not you have a CMBS loan if you do not know that. Then we're going to talk a little bit about the order of magnitude of this problem. We're going to look at an example loan that would be a distressed scenario, and then also kind of look at the market more globally just to identify the size of the problem and what's facing us. Then I'm going to turn it over to Todd, and Todd's going to talk through the CMBS structure. We're going to go into depth a little bit more than we normally do on how CMBS work. And I think the reason for that is it's really the complexity of the structure and the parties that are involved in CMBS that requires you to work with an expert if you are going to try to work one of these deals out. We get comments and questions all the time from our clients at the BSC Group. Why can't my real estate attorney handle this? He does all my closings. He does all my acquisition work. And the fact is that this is really a specialized product. There's a number of moving parts, and it really requires somebody that has a depth of knowledge and also contacts to be able to address these situations. I think when Todd's done, we're going to turn it over to Brock. Brock is going to walk through some of the strategies that we're using to work out deals today and the solutions that we're finding to be effective and that are receptive to the audience of special servicers that are looking to try to solve these problems. We'll give you an example of some broken deals or tell you what types of broken deals we're seeing, what the warning signs are with those deals, and how to know when to seek assistance. And then finally, we're going to wrap it up. Devin's going to come in and talk with you a little bit about the debt and equity capital that's available to go alongside workout deals. And then time permitting, we'll also overview some of the other capital markets products that are available today that we're seeing. So, let's start with who we are and why we're qualified to help you work out these deals. I think that most of you, hopefully on the phone, are familiar with the BSC Group. It was really formed in late 2009 as an extension of our former company, Beacon Realty Capital, by myself, Devin, and Neil Gustus, who I think a lot of people on the phone hopefully know Neil, and really all three of us. But we're a financial and loan advisory services company with a heavy emphasis traditionally on mortgage banking and increasingly on workout solutions, given the volume of CMBS debt that we have originated in the past and some of the problems that our clients are facing. Our firm has a heavy emphasis on the self-storage market, so we really understand the product, and I think that's important. And together, over the last 10 years, we've secured more than $1.5 billion in financing, debt, and equity, both for our storage clients. On the phone from First Service Solutions, we have Todd Moore and Brock Andrus. We were supposed to have Ann Hambley today, and Ann has been ill, and we certainly wish her a speedy recovery, but Brock is going to join us and is more than capable of walking through the material that we're going to cover. First Service Solutions really is an interesting story. Ann Hambley started the company after running the servicing group for Prudential, really found the need in the market for a borrower advocate to help borrowers traditionally, or it started out as assumptions and defeasance for CMBS, as that process, which is as simple as it is, can really be time-consuming. She saw the need for a cottage industry to come in and help these borrowers navigate that process. And then increasingly, as the markets have deteriorated, and I think their primary job today is really helping borrowers restructure loans. And they have done a tremendous amount of this business. They've resolved more than $2 billion in loan restructurings and extensions and more than $1.7 billion in assumptions. And they focus on all property types. So if you're on the phone and you have other property types from storage and you want to talk with somebody, they are very capable of helping you, but certainly have an increased presence in storage through their exclusive alliance that we formed with the BSC Group. So let's talk a little bit, the focus of the call today is CMBS debt. It's not bank debt. So how do you know if you have a CMBS loan? These characteristics that I'm going to run through are typical of, but not exclusive to CMBS. They're generic qualifiers. The best way for you to know is either to talk with a qualified workout vendor who will be able to quickly, and what I mean by quickly is within a matter of minutes, tell you a lot of information about your deal if it is in fact a CMBS deal. Another very surefire way to know is really to examine your promissory note. You should have a copy of your mortgage documents, and within the promissory note, if you see language in the document that expressly allows for the originator to pool and sell the loan, then there's a good chance that that loan was originated with the intent to be securitized and may very well be a CMBS loan. Another way that you can know is what is your relationship, how would you characterize your relationship with the lender? If you've been dealing with Mort on at the corner bank for the last 30 years and he's the guy that originated your loan, chances are it's not a CMBS loan. If you originated your loan through a qualified intermediary, either a mortgage banking company or some other type of intermediary that was really helping you to go out and source loans in the market, the CMBS markets relied heavily on intermediaries to source their business, and so there's a good chance that loan may be a CMBS loan, and that person who originated your loan would probably be able to help you figure that out. Is your loan non-recourse? CMBS loans typically do not have personal guarantees, so if you have a non-recourse loan, either originated by an insurance company or one of the large national banks or through an intermediary, there's a good chance that is a CMBS loan. Another way, has the payee ever changed during the term of the loan? If you received correspondence after origination indicating that you should change where the payment is being directed, there's a good chance there's a servicer involved in that loan, and it may in fact be a CMBS loan. And then finally, what does the structure of your loan look like? If you have a fixed rate term longer than 5 years, there's a good chance that you have a CMBS loan. A lot of the CMBS money that was originated is 10-year fixed rate in term. but this one's tricky, and so it's somewhat pretty generic in its qualification. So then let's talk a little bit about a deal. Let's look at a deal and sort of your generic deal that was originated in 2005, 2006 vintage CMBS loan. In the top box, we have some deal characteristics. You can see that the stabilized cash flow at origination was $300,000, and in 2005, 2006, through that period of origination, loans were being originated pretty aggressively. So there's a good chance, the cap rate, 8%, not uncommon at all, leading you to a value at origination of $3.75 million. Full leverage at that time was an 80% loan, so your origination loan balance would have been right around $3 million. If we take a look at what the amortized balance on that loan is today, looking 6 months out, it was originated with a 30-year AM, you're probably right around $2.8 million. Now, the bottom box is really a sensitivity analysis that bands out your cap rate. And keep in mind that if you read the press or if you're looking at the material that is being published, indications are that commercial real estate values have declined about 25%. But let's just focus for a minute on that first column, the 8% column, and let's assume that your current value is still $3.75 million. So you have experienced no decline in value. Just given the new proceeds available in the market, which are pretty generically 70% across the board, you're talking about a new loan today of $2.625 million to take out your existing balance of $2.815 million. So in that scenario, everything being equal, you're talking about having to come to the table with $200,000 to refinance your loan. Now, the bottom line there looks at taking a 5% haircut to cash flow. I don't think anybody on this call would be surprised to hear cash flows have been disrupted by the recession. Certainly concessions are up, rents are being squeezed. So if we take a 5% haircut to your cash flow, the order of magnitude of that equity gap increases to almost $500,000. Now, if you go to the other side of the table in that 10%, 11% cap rate column, which really takes into account your 25% value decline, your equity gap is anywhere between $715,000 and $1.2 million on a $3 million loan. That is just staggering. I think it really gives you an idea of, these are problems that everybody is facing. These are problems that are very widespread. And so you take a generic deal like this and you take a look at it, and then you say, well, what is the order of magnitude in the market? And let me back up here one second. Here's an overview of sort of the global markets. You've got $3.5 trillion outstanding in commercial real estate loans, 23% of which are CMBS. $1.3 trillion scheduled to mature over the next 3 years. So you're looking at, $350 billion annually, of which a quarter of that is CMBS. I think that it's safe to say that there is going to be a lot of these deals that are going to need some sort of help and some sort of a workout. So with that, I'm going to turn it over to Todd so he can talk with you a little bit about the CMBS structure and get into depth on that. Todd?
Thank you, Sean. Let me go back here. Okay, this slide, it's rather busy looking, but the design of it is to take you through what a typical CMBS structure looks like from beginning to end. What you'll see on the far left-hand corner is what looks like a typical borrower-lender relationship at origination. The process feels like a traditional bank or life company loan, and in fact, from a borrower's perspective, it's very likely that the loan could have been originated directly or actually through a broker network. Moving over at some point after the loan has closed and maybe within a few days or weeks thereafter, your lender will sell the loan to an investment bank as well as the servicing rights. And in a rare occasion, the lender that you obtain the loan from may keep the servicing rights, and that entity is called the primary servicer, which you'll see later in this presentation. The investment bank will accumulate the loan product, and when there is a critical mass, either because of the loan balance or the number of loans within the pool, the investment bank will take that pool of loans to market and sell to third-party investors. The investments in the loan pool are evidenced by bonds that are rated by the various rating agencies. And these bond levels are tranched into levels ranging from investment grade, which is the AAA through the BBB levels, as well as below investment grade tranches, which are the BB through the unrated instruments. The investment grade bonds are typically held by pension funds, insurance companies, and agencies like Fannie and Freddie. And the sole purpose of concentrating their investment in the investment grade side is because they're looking for certainty and predictability of cash flow. Meanwhile, the below investment grade quality bonds are typically purchased by opportunistic investment firms and real estate companies that are looking for high yield returns and potentially a way to get at the underlying real estate securing the loans should any of these loans go into default. And the most important level of bondholder within the below investment grade tranche is an entity called the controlling class certificate holder. And this is the entity that is typically identified as the party holding a majority stake in the most junior level of below investment grade level bonds. And you may hear this particular entity sometimes referred to as the B-piece holder. The reason the designation holds such significance is that the controlling class certificate holder retains the power and the discretion to appoint the special servicer in any CMBS pool. And the special servicer is the only participant within the CMBS servicing community that is vested with the power to modify a defaulted loan. And any such recommendation is supposed to be in the best interest of all the certificate holders within the capital stack. However, this can seem inconsistent given that most cases the special servicer will look to the controlling class certificate holder for final approval of any recommended action relating to a defaulted CMBS loan. And that's the same entity that will suffer the first loss within a loan pool. Furthermore, many of the entities that originally got into the CMBS investment game as a controlling class certificate holder elected to form a sister company that would ultimately serve in that special servicing capacity. So many have argued over the years, and the debate rages on today, that while the special servicer is charged with making decisions that are in the best interest of all the certificate holders, irrespective of their investment level, that inherent conflicts are unavoidable if the special servicer is tied to the controlling class certificate holder. And that particular issue has many moving parts and goes way beyond what this panel presentation is designed to touch on today. But to suffice it to say, the controlling class certificate holder of all of the bondholders has an extremely important role in the makeup of the CMBS process. This next slide is really a pared down version of the previous slide, and it's designed to show you how the cash flow moves from borrower ultimately to the certificate holders in any CMBS transaction. Provided that the loan is paying as agreed, dollars flow from the borrower to a servicing agent appointed to service the loans within the pool. That entity is called the master servicer. You may see such entities as Wells Fargo, Wachovia, Midland Loan Services, and KeyBank serving in this capacity. On a specified date, the master servicer gathers all the loan payments and remits the dollars collected to a trustee, which in the CMBS setting, there are two primary trustees, Bank of America and Wells Fargo. The trustee, in turn, distributes the collections to the certificate holders based on their ratable share of certificate investment within each bond level tranche. The monthly distributions are paid sequentially. In other words, dollars are paid to the AAA levels first, followed by the AA tranches, and so forth. And so long as each loan is paying as agreed, all of the certificate holders receive their contracted bond payments. However, things change dramatically when a loan or loans fail to pay as agreed. Because the monthly distributions are paid in a sequential order, to the extent that a loan payment is short, the certificate holders at the bottom of the investment stack may not receive any distribution on a given month or months. Likewise, to the extent that a loan suffers a loss to principal, the certificate holders at the bottom of the capital stack suffer the first losses. And in today's environment, this is having a truly dramatic effect on the lower rated tranche bonds, including the ever important controlling class certificate holder. Recall earlier I said that the importance of the controlling class certificate holder is its ability to appoint the special servicer. And that to the extent that the original or any subsequent controlling class certificate holder no longer holds that designation as a result of an erosion of its investment positions, the right to appoint the special servicer transfers to whatever entity is next in line that holds the majority stake in the then lowest rated tranche of bonds. And the appointment of the special servicer, in theory, is now becoming more of a fluid proposition, and it can have dramatic effects on a borrower in a workout situation as a result of this change. And we're seeing the effects of this today, and I'll touch on what the impact is to a borrower later in the presentation. This slide reflects the parties that a borrower may have to gain consent or approval from on post-closing matters involving a CMBS loan versus a traditional borrower-lender relationship. And as you can see, the level of possible consent parties under a CMBS structure is much more involved and complex. Under the traditional structure, the borrower typically has direct access to his lending officer, and depending upon what's requested, perhaps the final decision maker. And clearly, it's not the case in a CMBS structure. Recall that in most cases, your loan is sold into a CMBS pool shortly after origination, and the servicing of that loan is transferred in most instances to a third-party servicer known as the master servicer. And you must remember that there are no relationships within the context of a CMBS structure. Each loan is a standalone investment, and it's viewed as a commodity by all the participants that are related to the CMBS structure and that represent the interest of the certificate holders. And by far, this is the most difficult concept for most borrowers to grasp, particularly those borrowers that are not accustomed to the capital markets lending landscape. But make no mistake about the realities. Traditional banking relationships are non-existent in a CMBS structure. And from this point, I'm going to focus on the number of defaulted loans in the CMBS landscape, the special servicers who touch the defaulted loans, and then what this means to you as a borrower. But before we talk about the specific special servicers, I want to share with you what the special servicers are dealing with in terms of defaulted mortgage loans. This chart that's in front of you is already outdated, and it was published in mid-March. And at the time that this went to print, there were $65.4 billion in CMBS loans that were with special servicers, and that's out of a total pool of loans of $790 billion. On the left-hand side matrix, you'll see that this reflects the origination vintage for the loans that are with special servicers. 76% of the loans that were with special servicers at the time this went to print were originated between the period 2005 and 2007, a period where the underwriting standards were the most liberal and trades for real estate were conducted at peak prices. So no surprise that you would find that these are the most prevalent in the default situation. As far as what the other matrix tells you, on the right-hand side, you'll see that the loans that are with the specially serviced assets are broken down in your 30, 60, 90-day delinquent category, as well as foreclosure and REO. What's interesting from the chart is that 23% of the loans with the special servicers at the time this chart was published were there and were considered current, but they were shipped to the special servicers with anticipation that they were going to become delinquent within the next month to 2 months. You'll also note that 41% of the specially serviced loans were in the 90-plus or foreclosure stage. So we've not seen the push for actual foreclosures as many have predicted over the last few months. And much of this is the inability of the special servicers to fully grasp everything that has been transferred to them. Furthermore, the special servicers are reluctant to push property out to market in the same depressed market that they're foreclosing in. To bring you to the present, what this chart does not show you is that as of today, there's approximately $75 billion of loans that have been transferred to the special servicer. So within 2 months, we've increased $10 billion. And predictions are that by the end of the summer, we're going to see that number go in excess of $90 billion. So who's touching the specially serviced loans? Well, principally, there are 4 primary shops that are working all of the specially serviced loans. They have 80% of the volume. And the 2 largest by far are L&R and CW Capital. Now, several of the firms that you see on this pie chart are experiencing financial problems themselves, and L&R and CW Capital fall into that category. And in fact, not only are they having financial problems, but they're also being shopped as we speak. So what does this mean to you as a borrower? Well, the worst thing for you as a borrower is that you're in the process of negotiating what you think is an acceptable arrangement. Your special servicing account officer has agreed in principle. He or she takes that to committee, and all looks well, and the next thing that you're waiting on is the call that says, we want to document the transaction. But instead, the call that you receive is one that says, we are no longer the special servicer. We're transferring the special servicing rights to a new entity as a result of either the controlling class certificate holder that was on that pool of CMBS loans has lost its position or has actually been sold to another party. And unfortunately, we're seeing this become more prevalent each and every day. Typically, the special servicers were a very static pool of players, and loans didn't move from entity to entity. But the times have changed, and it's a direct result of the massive delinquencies and losses that the controlling class certificate holders are experiencing. So from a borrower's perspective, what does this mean? Well, obviously, you need to know who your decision maker is. It's critically important. Each of those decision makers that we saw on the previous slide have very different philosophies and have staffs of varying levels of sophistication that will treat different scenarios and differently, as well as some are more focused on liquidation, while others are focused on trying to be pragmatic and get through this downturn. To the extent that you don't know who your decision maker is, as Sean said earlier, there are ways for us and the BCS group to find who the names are and the players are in a very short period of time. And this can be critical information as you're assessing what your options may be. As I stated before, the loan volume for problem loans is overwhelming within the CMBS landscape, and not the least of which for special servicers. And that in and of itself is a significant contributor to the expanding length of time that it's taking to secure a resolution on defaulted loans. There was a recent published report that suggested that it's taking 19 months on average to come to a resolution on a loan once it's transferred to a special servicer. So patience is paramount in any workout. And finally, the additional driver that's contributing to why it takes so long to get to a resolution is that there's a lot of uncertainty with respect to what the value is on any asset. At this time, I'm going to turn over the reins to my colleague Brock Andrews, who will walk you through various workout strategies that we're seeing today and when those various options may be applied for a given situation. Brock?
Thanks, Todd. Thanks, Sean. I appreciate everybody joining us today. I'm going to try to cover the general philosophy that exists within the lenders or the special servicers that you're dealing with, and then we'll get into some varying examples. The first slide here shows this kind of bullseye concept, and basically these are all the tools in the tool belt of the special servicer to handle a workout if they were going to do a modification with you. Alternatively, if they don't do one of these concepts, then they're probably looking to foreclose and liquidate through their REO. But through a modification, they have varying tools to play with. Now, obviously, their primary goal is to lose the least amount of principal on their loan. So in a situation where you have a loan that is almost meeting debt service but is just shy a bit on cash flow, they'll first look to strip away the reserves, whether that's a debt service coverage ratio requirement reserve or outside of the self-storage world, there would be TIs and leasing commissions on a retail center, and they'd look to strip those away. The next would be amortization. If it's not already IO, they would take away the principal. If that does not alleviate the problem, then there's varying degrees of how they can eliminate some interest. If all of those solutions don't get the loan or get the borrower to cash flow, then the next obvious place to go is to the principal, and that's some type of writing down of the debt. The tax and insurance reserve is in red because that's the sacred cow. They're not going to be allowing any elimination of tax and insurance impounds. That'll always be in place. Moving to the next slide, I want to talk to you generally about maturity extensions. This is the probably most common workout that is done in today's market. If I can get the slide to go. Most loans have 5 or 10-year maturity extensions. So all those loans that are maturing at this time or have balloon payments are finding themselves in a very tricky environment with very little financing opportunities. So as Devin will discuss with you momentarily, there are some financing opportunities making themselves available. But still a very challenging environment, and as a result, the maturity defaults are the primary concern for most borrowers. When we get a maturity default deal in our shop, the typical terms that we see, and this is not uncommon to the rest of the market, but it's a 12 to 24-month extension, and typically the borrower would pay 1 point. Depending on the size of the deal, we can probably get that down to a half point, but I would always bet on 1 point to the servicer on the outstanding loan balance. And depending on the special servicer that you have, they're going to require some type of principal pay down. And typically this is 5 to 10% of your total outstanding balance. And with the 12 or 24-month extension, there are typically options to extend for an additional 12 months. But to exercise that option, they usually require an additional point to be paid to the servicer, in addition to another 5 to 10% pay down of the principal. Now they won't start looking at, the servicers won't start looking at doing an extension on a maturity default really before 90 days. So 75 to 90 days before a maturity default is the time that you need to start talking with a firm like ourselves or BSC Group to determine what the likelihood of a successful outcome would be. Now, what is very imperative to prove up to the servicer is that you have gone out to the market and experienced multiple declines or no thank yous from other lenders. So it's best to put together, if you were to work with a group like BSC who is to go to take your package out to multiple lenders, we would request that they or any other firm like them put together a matrix that basically shows all the firms that the package had been sent to and their response or the reason for decline. This gives the servicer some feeling of comfort that all options have been exhausted. They really would like to view themselves as the lender of last resort. The next slide, let's talk about some loan modifications. So you have an asset, you have a self-storage property that has experienced some rental rate declines, a slightly higher vacancy rate, but not overwhelming problems. And you feel like if you just had 12 or 18 months of a little bit of breathing room, you could make it and round the corner. In those situations, what we typically try to do is look at the amortization and having that stripped away. And that can be anywhere, depending on the maturity, how far along you are in your loan payment, but that can be anywhere between 10 and 25% of your monthly debt service payment. So that alone can, in many cases, resolve such an issue. Obviously, the goal is to reduce the cash flow pressure and make the loan perform. Secondly, if the rental rates have compressed farther than the original example, vacancy is spiking higher than the original example, and you have a real cash flow issue, But you have plenty of time on the note, and you're not worried about the value issue because you don't have to be faced with paying off the loan within 5 or 6 years. You've got plenty of time for the market to turn around, but you've got significant challenges in the next 12 to 18, 24 months. In this case, obviously we try to strip away the amortization, and then we work with the lender to reduce the interest rate. And typically what happens is we get the interest rate lower to a point whereby you can cash flow. Now, you're not going to have significant breathing room, but you're going to have enough room, maybe a 1.1 or 1.15 debt service coverage ratio in order to not be in monetary default. So they'll lower the interest rate to give you that kind of coverage, and then look at every 12-month increment and look to increase that rate. So if there was a 3-year modification done, the first 12 months may be an interest rate of 2% IO. Then possibly the second year could be a 4.5% interest rate IO. The third year, 5.5%, and then at the completion of that modification, all things revert back to the loan documents. What's important to remember is in most cases, and not all, but in most cases, these lenders, again, going back to the principle that they don't want to lose any money, most lenders will accrue this interest that has not been paid and either place it on the back end of the note, which would be adding to the principal, or after the modification period is completed, say this 3-year period, and things are right in the world and you have great cash flow again, they will require that accrued interest start getting paid out of free cash flow. But there are those occasions when we can get the lender to completely waive all this this deferred interest. But in most cases, it will accrue. Now, at what time do you need to approach a shop like us or to start working with their lender? Obviously, most of you know when the cash flow pressure is so dire that things need to change in order for you to stay afloat. So again, they've got so much volume on their plate that they're not going to be taking deals under consideration if they're still able to survive. There's plenty of deals for them to work on that are not surviving. So I mean, when it gets right to that 105 debt service coverage ratio, that's when we really like to jump in and start analyzing the situation for our client and getting that information into the appropriate hands on the lender side and making them aware of the issue and showing them that in the near term there's an imminent default situation likely to occur, and start trying to have meaningful discussions. Let's go on to the next slide. Now, in a situation where your cash flow is not your only issue, you also have significant capital improvement dollars that need to be infused into the asset, and you have a value issue as well. So if you had a $10 million self-storage building and you have 3 years left before the note matures, the current value of the asset is $8 million, and there's a CapEx requirement of $1 million. Most borrowers say, listen, I do not want to put that $1 million at risk on top of $10 million worth of debt when the value is only $8 million today. I'm never going to see that new money back. And so a structure that is often employed under that scenario is this A-B splitting of the note. So you take the $10 million note and you bifurcate it into 2 notes. You would have an A tranche and a B tranche. The A tranche would represent today's value. So you would have an A note of $8 million, and the remaining B note would be the difference between the A note and the outstanding balance, or in this case, $2 million. The borrower would then infuse his new $1 million that are required for CapEx. He would infuse that money between the A and the B note. And so at this point, he is placing new capital at risk on top of property leveraged debt. Typically, the order of priority in this structure for payoff from cash flow or through a liquidation event is the A note gets paid off first, the borrower's new equity, or in this case, the $1 million gets paid back. And then there's some kind of splitting of cash flow. And in some cases, that's 50% to the B note and 50% to the borrower. But those percentages change based off the deal. In the event that there's not enough proceeds to pay off the full B note, then the lender has agreed in this structure to waive the outstanding balance that is not paid off through a liquidation event without having any further recourse. Now, timing and critical issues, like I explained, the time is whenever you need to put significant dollars, new dollars into the project for whatever reason, value is not there, and you have great concern about putting dollars at risk onto an asset that's over-leveraged as it is. There are some servicers that will not consider this structure, but those are just a very few of them, one or two of them that won't consider it. Most of the larger players will. Now, the next structure is the discounted payoff structure. There's not much of a structure there. It's more of negotiating a price whereby you can pay off the note at a discount. And this is a commonly used tool from the lender side. And the reason this is pretty common is in most cases, lenders would prefer, well, not in most cases, I would say in many cases, lenders would prefer on certain assets to no longer take the real estate risk or the borrower risk with the asset, and would prefer to liquidate their position and move on. Now, with that said, most people think, well, great, this is an opportunity for me to get an excellent deal in the market. I would caution you from thinking that, though it does allow you to buy down, as it were, your risk and to enter in at a new basis, which is always attractive. But it's not as if you're going to be able to orchestrate a better-than-market deal. These lenders are very sophisticated. They have thousands of assets around the country. They have multiple touch points. They know where, if they don't know where value is just because of lack of trade, they have a pretty good sense generally of where an asset's going to trade at in their REO side. And so they have a pretty good feel on what the market's saying on value. So to think that you're going to be able to go in and get a sweetheart deal, no. Are you going to be able to get a sweetheart deal because now you're able to buy the asset at today's value? Yes. And that is a great tool. Now the problem some borrowers run into is needing the capital in order to pay off that debt at a discount, and we can certainly help resolve that concern through our capital partners. And with that, I'll turn it over to Devin, who can explain how to find some money to take care of these problems.
Great. Thanks a lot, Brock. You presented a lot of great information. Well, one of the first places you need to, or the first things you need to know when determining whether or not you're in a distressed situation is what capital is out there available. And, you know, the news is getting better on that front. What I'm going to go through is tell you a little bit about the mezzanine capital and equity that is now just entering the market, and then moving on to talk a little bit about the insurance companies, what they're doing, and then touch on the CMBS market. Let me get the slide. All right, what is mezzanine debt? Mezzanine debt sits between the first position mortgage holder and the equity. It represents about anywhere from 10 to 25% of the capital stack. So it becomes a viable solution for anyone facing a maturity default where they have an equity gap, due to what Sean talked about, which is an increase in cap rates, a decrease in the available leverage and pressure on your NOI. So if you're facing that equity gap, a mezzanine loan is a good potential solution. One of the issues with mezzanine loans is they require a second lien, and so when you're working with a special servicer, it doesn't help unless you're willing to pay off your CMBS loan. It doesn't help for an extension because very few CMBS loans allow for a second in place. So let's take a look and see, how is a mezzanine loan structured? Well, what we're seeing in the market is, they're typically looking for $1 million plus in loan amount. And so that's tough for many self-storage facilities just due to the inherent size of a self-storage facility. So practically speaking, we're really limited to deals that have a $4 million asset value and up. And the way we would get to $1 million mezzanine piece is by, putting a first mortgage of 50% on that property, and then putting a mezzanine piece of 25%. So you have a $2 million first mortgage and $1 million second on the property. Now you're encumbering the property with a big chunk of high leverage debt. But the good news is, the 50% first mortgage, you're going to be at an interest rate, most likely with a 5 handle on it. And so, the mezzanine piece, which is going to be somewhere between 10 and 15%, when you do a weighted average of cost of capital, you're probably, it's not as bad as you're thinking. How do they underwrite the transaction? They're going to look to consider the entire debt service on all the debt outstanding against the property, and underwrite that to a 110 debt service coverage ratio. They're not going to want to exceed 85% of the MAI appraised value of the property, and I would say 80% is probably a better rule of thumb. 85% would be a special situation, and they're going to want monthly payments made of interest, and it's going to be between 10 and 15%. So it is, relatively high as far as interest rates, but, it gets you to the leverage point you need to be. They're really only considering Class A and Class B properties in top markets. So, you just keep that in mind when, looking at considering mezzanine debt as a solution for you. Another solution that is starting to become much more available in this market is what I've termed dequity, or preferred debt, or participating debt. And what that is a hybrid capital structure that has both debt and equity characteristics. It again can be used to fill the equity gap when there's not enough cash flow to service, or to use traditional mezz. But there is upside in the property. One of the great advantages of this type of structure is they don't require a second lien against the property. So this can be used to fill that equity gap when trying to negotiate an extension with your special servicer. So what are we seeing as far as structures with regard to dequity or participating debt? The term, usually the lender doesn't want to be out more than 3 years. They're going to want some portion of the return paid currently through a preferred return, and they're typically looking for a 6 to 9% interest rate on that, and that would be a monthly payment. The remainder of the return they're going to get through participation of equity that allows them to achieve a 15% IRR over the average life of the loan. That might come down a little bit if you're paying off the loan, after 1 year, and that might increase a bit if you're extending beyond 3 years. The other nice thing about this structure, because they're generating higher returns, the loan size is significantly lower. We're seeing players in the $250,000 range, which really opens up this product to many more self-storage owners. Really, the collateral value needs to be right around $2 million for this to work. And with that, one of the signs is the fact that mezzanine debt and equity are back in the market really tells us that lenders and equity players feel that we're at a bottom or close to a bottom, and values are going to start to increase. So I think it's a really strong sign for things to come. I'm going to turn it over to Poppy shortly. We've only got 10 minutes left, and I'd like to have some time for some questions. So I'll just quickly touch on what kind of capital is out there. Terms are getting much, much better than they were 6 months ago, 3 months ago. Insurance companies have a very strong appetite. We're seeing loan to values increasing. 65, 70% plus is not out of the question. Interest rates are the bright spot right now. We've seen some interest rates as low as sub 5%, all the way up to for 10-year deals in the mid-6s. So very competitive interest rates. So there is capital out there, and we encourage anyone that wants a briefing on the capital markets to either give myself or give Sean Hill a call. If you're on the West Coast, feel free to call David Dorich, and we can sit down and walk you through exactly where the capital markets are. With that, I will turn it over to Poppy so she can answer your guys' questions.
Okay, we've got quite a few questions. I'm going to pull them up in the order they were received, and you guys can go ahead and answer. First one, what are the charges, and are they performance-based, or is there an upfront fee?
This is Brock. I'll go ahead and answer that. I'm assuming the charges, meaning the fees that we or BFC Group charges. And yes, the answer is yes to both. We do have upfront fees, and it varies on the size of the deal and the complexity, but there are some engagement fees and a restructure plan basically where we would write a full business plan, if you were. And in addition to that, then upon success, we would have some additional fee that would be paid. But typically, I would suggest that this is all in, anywhere between a half a point to a point, depending on the size or the complexity.
All right, next question. Capital may be available for top-tier properties, but what about secondary or tertiary properties?
Poppy, I'll answer that one. This is Devin. There are specific insurance companies that are focusing on tertiary markets. You're typically a deal of in a tertiary market is going to have a loan to value between 60 and 65%, an interest rate in the mid sixes, and you can expect a term of 5, 7, or 10 years. But yes, there is money available for properties in tertiary markets.
Okay, next question. Can you comment on investor confidence? For example, who would have confidence in this market with current uncertainties and a kick-the-can mentality?
This is Brock.
Do you want me to answer that, Brock, or do you want to go ahead?
Yeah, go. Feel free.
Well, I think that what you're seeing in investor confidence really right now is you're starting to see hedge funds and other opportunistic players, real estate funds that are looking for value. So you certainly are starting to see money flow back into the markets. We're seeing hedge funds coming back into the markets. And with a lot of these products that we're talking about, I think it's important for the investor, that being the borrower, to understand that if you get into a situation, for example, in the equity situation that Devin described, that person is really going to become your equity capital partner. And at the end of the day, if there's a capital call and you don't perform, you are probably going to lose the property to that person. But it is certainly a last resort option. In terms of debt that's coming into the market, I think that what you're seeing is, generally speaking, it's available. It's just available at much less aggressive rates, or much less aggressive. What's the word that I'm looking for? Advances than it was before. So if you had lenders coming in at 80, 75% before, they're probably comfortable today at 65%, particularly recognizing that values have declined. So they're now lending 65% against a value that is much lower than what the lender 3 years ago was advancing more proceeds towards. So they feel comfortable with value. And certainly it goes without saying that in every one of these deals that we're talking about, the merits of the deal need to stand on their own. Nobody is going to enter into a deal and start putting capital into a real estate property that they don't believe in. So if your property is inherently broken, if your market is inherently broken, I think that's really important now to look in the mirror and start to decide what you're going to do and what your options are.
All right. The next question is for Brock. Brock, values went down 25 to 40% in some cases. Why do you think they will get back up to their value, particularly with lingering unemployment?
I certainly wouldn't expect or suggest that I think in all cases, or in most cases, that values will reach their levels if you're talking about 2006, 7 values. I think that we all would recognize the value at that point was inflated. Now, maybe the question is related to the AB structure or some other derivation thereof. But in the AB structure, it is kind of pre-assumed in that structure that the value may never get back to the full the full debt level that is on there, and that's why in that structure, it's put in so that whatever is not able to be paid off of the B note in a liquidation event, it is wiped away. I fully expect there to be a recovery, and I think most of the specials look at the recovery. Though there's a few that look at it as a V-shaped recovery. I would tend not to agree with that. I would think it's more of a U-shaped, a slower, drawn-out recovery, and I think that's primarily because there's not enough trading going on. There's not enough reality on the ground as far as what values are, and that's because there's just not as many properties have been taken back, either from banks and put out on the market or from the CMBS lenders and put to market yet. But I think the time is short at hand where there's going to be more reality as far as what values are today, and from that point, I think we start to see a slow trend upward. But there are several servicers out there, CW primarily, that think that this is a V-shaped recovery and expect a strong return to the 03, 04, 05 values.
All right, next question. Do I need to be in default in order to get transferred to a special servicer?
I'll take that one. This is Todd. Historically, we would have said no. And in fact, we do not encourage borrowers to go into default. What we do tell you is that if you're subsidizing your debt service, you're not going to get any credit for that when you go to the special servicer. So it may be better to preserve your capital and just pay the cash flow. And I started out this response by saying we don't advocate going into default, but what we are seeing is a trend by servicers who we believe are not doing their duty under the servicing agreement by informing borrowers that the only way that they can get their loan transferred is to default. And that's clearly goes against the grain and the intention of what the servicing agreements call for. There's a term called imminent default, which would suggest that while you're not in default, taking all things into consideration, you're certainly going to be there without some change. But given the swell of actual defaults that are occurring in the market and the inability of the special servicers to administer what they've already got on their plates, they're basically pushing back to the master servicer. So the master servicers seem to be taking that to mean that you can't get a loan transferred unless it's an actual default. So before you go to those extremes of making the decision to default on your loan, certainly we would want to talk to you about it and kind of walk you through all of the sort of the positives and the negatives for doing that. But the tide is definitely shifting where default seems to be the way to get to the special servicer.
All right, next question. Both my accountant and my attorney have offered to assist me in working out my CMBS loan. Aside from the costs, what are the differences in working with you or working with them?
Again, I'll take this one. I mean, we're from First Service Solutions perspective, most of us here have been in the servicing business for most of our careers, and that's critically important in dealing within the CMBS structure. I mean, there's certainly nothing wrong with an accountant or lawyer doing something and representing you, but typically if your lawyer represents you, the first thing the servicer is going to do is stop talking to you because they're going to get their lawyer on the phone, and that's going to rack up fees on both sides relatively quickly, and that's all going to come back to the borrower as far as payment. In terms of an accountant, again, nothing wrong with being represented by your accountant, but if you don't know who the players are, if you don't know how to ask a specific, in a specific way or say a specific thing, if you don't do it every day, you may end up having unintended consequences coming out of what you thought was a relatively simple phone call. Our background is in the servicing area. We know who the players are. We know many of the management staff, and we know what the servicer's likes and dislikes are, and we try to figure out a way to maneuver around some of those likes and dislikes to get you the best outcome. So again, certainly no reason why you can't have an accountant or lawyer represent you, but we feel like that we bring the added value of understanding the mindset of the special servicers, the master servicers, and then the entire framework that maybe someone who does this part-time or none of the time would have benefit of.
And I would only add, Todd, Brock, I would add that an accountant is an integral part in the picture here. It's very important to understand your tax consequences and the ramifications of any debt forgiveness of any nature. So very important element in the overall picture of a workout. And secondly, legal counsel is always a critical, important part of the process. We have very strong relationships with most of with very large law firms that deal with our high-profile clients, and we work in kind of a team or tandem effect. Most of the time, on the front end, while we're getting through the nuances of getting a package assembled in a way that the servicer wants to see it, putting deal structures and modeling those out financially like the servicer wants to see it, we take the bulk of the load. Once we get through those initial negotiations and through committee, the load shifts from us to legal counsel as they craft the actual document. And so all three components are an integral part of the overall team that gets this thing accomplished at the end of the day. So it's just where each team member should place his focus.
And Brock, this is Sean. I want to add a third. That's a good question because I want to add a third component of it, which is I think the people on the phone really need to understand that a major part of what we do is developing the restructure plan. It's fine to go to the servicer and say, look, I've got an imminent default. I got to throw my hands up. I don't know what to do. But the fact is they want to understand what the options are. And one of the reasons we created this alliance with First Service Solutions was to bring some self-storage knowledge, expertise, and connections to the table, because in writing that business plan, one of the things that people can appreciate is self-storage has held up very well, and the servicers do not have a lot of self-storage. So it tends to get that effect of, geez, I don't want to deal with this. This is messy. I don't understand it. There's 500 tenants. They change every month. What the heck is going on here? I'm going to put this one aside and work on a multifamily deal, which is a lot easier for me to get my arms around. And so I think that, people need to understand that writing that business plan, helping the servicer to be able to see what method is going to preserve asset value the most is a very powerful and very important part of the plan. So that's, I think, a differentiator, obviously, with working with somebody that might be doing this part-time or is just casually throwing their name in the hat to try to help you out.
Okay, with that, we have other questions that I'm sure you will all answer on individually afterwards, but we have run out of time. In closing, we'd like to thank everyone for attending. We hope that we provided you with some useful information to assist you in your self-storage endeavors. Just as a reminder, you will receive an email within the next few days with a link to the archived presentation, so be sure you watch your inbox for this email. And our next webinar will be held on June 23rd, sponsored by Universal Management Company. The topic will be finding hidden money in your store's operating reports, and the presenter is Ann Ballard. To sign up for this or any of our other future webinars, please visit ministoragemessenger.com. Thank you again, and have a wonderful rest of the day.